So let's begin with the big issue. Markets betting on a wave of easier policy from global central banks.
Most central banks are expecting to be cutting rates.
The RBA typically moves a couple of times.
They were the second. The New Zealanders have already gone.
We will likely see further Asian central bank easing.
On the PBOC, obviously, we do expect further easing.
Jay Powell also opened the door, potential interest rate cut.
He's effectively laid the groundwork here for a cut.
The Fed might actually throw in an insurance cut.
Some kind of insurance.
If they do need to move, it's probably going to be multiple cuts.
The market's already priced for 3 rate cuts.
They could cut rates quite a long way.
They will act.
All the Fed is worried about at the moment is additional headwinds to the economic growth outlook, which are seemingly starting to mount.
Joining us around the table here in London, Jonathan Stubbs of Citigroup and Peter Oppenheimer of Goldman Sachs. And guys, we have got to start first and foremost with that really soft ADP print around about 45 minutes ago. 27,000, median estimate 185. And beneath the surface, it feeds the anxiety because it mirrors the weakness in the US economy right now. The weakness is in manufacturing. It's not in services. Typically, Jonathan, we'd ignore an ADP report. Why does it matter so much now, if at all?
I think investors are unanchored, I call it, and therefore looking for signals, and sentiment is very volatile around those signals. So every data point at the moment is much more emotionally charged into the market. So 1 week data point, and you see a very big reaction in the bond market. That's what we're seeing today.
And we're seeing that right here, right now, with yields aggressively lower at the front end. What are your thoughts on all of this, Peter?
Well, I agree with Jonathan that there's a high degree of sensitivity to the growth data, partly also because of the unknown as yet full impact of the trade dispute, but the expectation that the data will weaken as a result of that. And indeed, the pace of growth has slowed in the US. So on our current activity indicators, currently growing at around 1.4%. It was at 2% in March and around 4% this time last year. It's still growing close-ish to trend, but that slowdown, with the weakness that we're seeing elsewhere in the world, I think is raising this expectation that we could see rate cuts.
An expectation, a much bigger expectation after Chairman Powell spoke. Guys, what I want to do here is bring you the quote from Chairman Powell, and then you ask you if there's anything really new in the communication from the Federal Reserve here whatsoever. Quite clearly, markets heard what they wanted to hear yesterday. This is the quote from the Chairman. "We are closely monitoring the implications of these developments for the US economic outlook, and as always, we will act as appropriate to sustain the economic expansion with a strong labour market and inflation near our symmetric 2% objective." Jonathan, what's in that? What's new? Why did that feed the biggest one-day pop in the S&P 500 in 5 months?
I think markets were short-term very oversold. I mean, remember the last 2 weeks in May were brutal in the bond market. Treasuries heading down towards 2%. Equity markets were hit very hard. So near-term oversold, and again we saw a very strong, almost emotional reaction from markets, a very exaggerated reaction to the Fed coming out and saying we're doing our job. But we're doing our job with an eye on the data, which is exactly what's happening.
So the headline, Peter, that everyone's run away with is that the Federal Reserve is opening the door for a rate cut. Is that your view of things? Is that what's happening here in the last 24 hours?
Well, I think our economists in the US would argue that the Fed is on pause. Actually, you do have a very strong labour market, notwithstanding the latest data. And it's a very extended economic cycle. We're approaching the longest in 150 years. So it's not clear that they will cut rates. And the market is actually pricing quite aggressive rate cuts from here. And given that actually part of the impact of the trade dispute is rising inflation, it may be that we don't get the kind of rate cuts that the market is beginning to price.